Inflation is the Fed's tool. That's the only tool they actually have in their chest for trying to artificially stimulate the economy. You know, Powell said that the Fed's job is to support the economy. That's not the Fed's job. Unfortunately, that's what Powell thinks is his job, and he thinks the way you support the economy is by creating inflation. Well, the problem is he created way too much inflation, and now inflation is the problem, and now he's trying to solve that problem with more inflation. And, you know, Powell indicated that for a while he could keep doing quantitative tightening while they're cutting interest rates. Well, I think by Q1 of next year, the Fed is going to be back to quantitative easing because the rate cuts are not going to stop the recession, and they're going to result in higher long-term interest rates.
As October approaches, investors closely track market moves to predict Bitcoin's course, hoping to benefit from the traditionally strong increase in October, known as Uptober. Last year's October saw strong gains, sparking a major bull run, and many are wondering if this year would follow suit. However, broader economic issues may influence Bitcoin's price. The Federal Reserve's latest rate cut of 50 basis points has sparked heated discussions. An economist and investment expert, Peter Schiff, slammed the move as a folly that would feed inflation. He pushes for higher interest rates to combat inflation, encourage savings, and stabilize the economy, arguing that rates should be determined by the free market rather than central planners. The impact of the rate drop on the Bitcoin price and the overall market remains to be seen. Peter Schiff predicts that the Fed will resume quantitative easing in the first quarter of next year to lower long-term interest rates. This will weaken the currency even more, raise gold and commodities prices, and exacerbate consumers' economic hardship. Schiff advocates boosting interest rates to combat inflation, which contradicts the Fed's present policy. Watch clips from the interview for further insights into Peter Schiff's argument. Please like this video, subscribe to the channel, and turn on post notifications for more content. Enjoy the video.
Peter Schiff, there was one dissent. This was not unanimous. Michelle Bowman did say she thought it should be a 25 basis point cut. Do you see a mistake here?
Well, I mean, any cut was going to be a mistake. I think the Fed caved into the pressure of market expectations and cut 50 when they probably were set to do 25 a week or two ago. But I think they changed their minds. But look, you know, the market is delivering a verdict here. Interest rates are rising. They're not falling. Long-term interest rates are going up. And I think the Fed rate cut marks the low in long-term Treasury yields and mortgage yields. So I think you're going to start to see rising interest rates as the Fed cuts rates. And so you're not going to get the benefit that you might assume. Well, you're going to get an increase in consumer prices.
Truist has just cut its prime rate, Peter, to 8%. So they're coming down.
Yeah, but that's a short term. And of course, depending on what rate you get over prime, rates are headed up. Credit card rates are going up. They're at record highs and they're going higher because defaults are rising. And the inflation is not dead and buried like Powell claims. It's about to come back for a whole new lease on life. In fact, it never really got close to 2%. The Fed is playing around with numbers. And I think we're already in a recession. It's not about how strong the economy is. I mean, that was just all a bunch of talk because he's trying to talk up the economy because he's trying to help out Harris and try to, you know, continue this false narrative that we have a strong economy. We have a weak economy. The only thing that's strong is inflation, and people are about to see how much stronger it's about to get now that the Fed is throwing gasoline on the fire. Well, look, if Powell cared about inflation, he never would have cut interest rates to zero in the first place or left them there as long as he did. He wouldn't have done all this quantitative easing. Inflation is the Fed's tool. That's the only tool they actually have in their chest for trying to artificially stimulate the economy. You know, Powell said that the Fed's job is to support the economy. That's not the Fed's job. Unfortunately, that's what Powell thinks is his job, and he thinks the way you support the economy is by creating inflation. Well, the problem is he created way too much inflation, and now inflation is the problem, and now he's trying to solve that problem with more inflation. And, you know, Powell indicated that for a while he could keep doing quantitative tightening while they're cutting interest rates. Well, I think by Q1 of next year, the Fed is going to be back to quantitative easing because the rate cuts are not going to stop the recession, and they're going to result in higher long-term interest rates. And then the Fed is going to try in a panic to reduce long-term interest rates by going back to quantitative easing. and that's just going to increase the pain because it's going to send the dollar through the floor, gold and other commodity prices through the roof, and consumers are not only going to be dealing with a loss of jobs, but much higher prices when they go to the supermarket or any place else that they try to spend their rapidly depreciating dollars.
According to Peter Schiff, interest rates should be set by the free market rather than administrators. Artificially low interest rates result in excessive borrowing, record debt, and insufficient savings. The United States has record low savings rates, record high government debt $34.3 trillion, household debt, and credit card debt. Schiff argues that interest rates are too low, encouraging borrowing while discouraging savings. Higher interest rates would encourage savings, limit borrowing, and drive the government to cut spending. The Federal Reserve's 50 basis point rate drop is wrong. Rates should be raised to restore equilibrium. Schiff says the Fed's activities reflect a bubble economy based on spending and credit. The Dow Jones and S&P indices are at record highs, implying that interest rates are too low. Schiff supports higher interest rates to combat inflation and stabilize the economy. Let's return to the interview and watch more clips to gain insights from Peter Schiff's unrelenting onslaught on the Fed's rate cut.
In capitalism, in a free market, that price would be set by the market, but it's not being set by the market. And like any price control, the level that government central planners pick is wrong, right? The free market discovers the correct price, but bureaucrats who just select a price, right, always get the wrong price. And usually because they're politically motivated to either set the price too low or too high, right? With the minimum wage, it's high price and you get unemployment. But here now for interest rates, the powers that be, the pressure is to have a low rate. And that's what we have. Because if you just took an objective look at the American economy and looked at the record low savings rate, right? All-time record low personal savings rate. You looked at the record high debt that we have, not just record government debt, where we're 34.3 trillion in debt, but record household debt, record credit card debt. Everybody is loaded up with debt, and there's very little savings. What does that tell you about interest rates? That they're too low, right? Because low interest rates both encourage borrowing because borrowing is cheaper, and they discourage savings because you don't earn a high return on your savings. Now, absent the government's intervention, interest rates would have to be much higher to restore some type of balance where the higher rates would encourage people to save because they would earn more interest on their savings, and it would reduce borrowing because borrowing would be more expensive. And so there'd be less borrowing, including the government. The government would have to find ways to cut back on its spending because the cost of financing the borrowing would be too high. So we know objectively that interest rates in this country are too low right now. Yet despite that, the Fed just cut interest rates by 0.5%. The purpose of this 50 basis point rate cut was just a recalibration of policy to get closer to a neutral stance, that they didn't want to be tight anymore. They wanted to be neutral, but they were never tight. They've always been easy. And the proof of how easy the Fed has been is the amount of debt that we have, right? We wouldn't have all this debt and such a shallow savings pool if we had high interest rates, if the Fed was tight. Also, if the Fed was tight, the Dow Jones wouldn't be at an all-time record high, which is where it is. And of course, the S&P, which is a little bit off the high, the NASDAQ, but they made record highs this year. They have huge gains. That is a sign that rates were low, right? If the Fed really got restrictive, we would have had a big bear market. No question about that. And if the Fed really was restrictive, we wouldn't have, this record low savings rate. People would be saving more and taking advantage of those high yields. And we wouldn't have all this borrowing. We'd have spending cuts. But we never got that. The Fed never achieved tight money. Why? Because they were afraid, because they know we have a bubble economy that depends on spending and credit. And so the Fed continued to provide it, although they provided it in a lower dose, right? But they still provided it. But at some point, right, even though money was cheap, it wasn't cheap enough, and the banks started to fail. And so the Fed stopped hiking and then started promising cuts. And that forward guidance in and of itself was an ease of financial conditions. And so the market started to price that in. That's why the long end of the bond curve came down so much. That's why mortgage rates came down, because everybody started to price in these Fed cuts. But the cuts shouldn't have happened. The promises shouldn't have been made. Rates needed to go a lot higher.
As economist Peter Schiff criticizes the Federal Reserve's 50 basis point rate cut, citing its tendency to feed inflation rather than prevent a recession, investors are anxiously watching how this decision may affect various markets. Schiff argues that the Fed's activities will result in higher long-term interest rates and greater consumer costs, emphasizing economic stimulus over inflation containment. This economic development occurred because Bitcoin had a historically beneficial moment. Bitcoin has consistently performed well in October, with 9 out of 11 positive monthly closures since its introduction. According to CoinGlass statistics, Bitcoin has had 5 consecutive green monthly closures in October, including a 28.52% spike in October 2023, which launched a multi-month rally, and a new high of $73,780 in March 2024. This remarkable development revealed Bitcoin's potential and highlighted the importance of October as a catalyst for upward momentum. If Bitcoin duplicates this increase in October 2024, it may reach $81,000, with investors cautiously optimistic. Bitcoin consolidates at $63,000, indicating a potential support foundation for an oncoming surge. The cryptocurrency is also in an accumulation phase, which suggests that huge investors are preparing for a potential October boom. Market sentiment adjustments following the latest Fed interest rate drop and Bitcoin's historical performance in October fuel cautious optimism among investors. Bitcoin's previous success in October cemented its status as a month of promise for the cryptocurrency. While previous performance does not guarantee future results, the data indicates that October could be a turning point for Bitcoin. With a week left in September, investors eagerly monitor Bitcoin's price moves for signs of a potential rise. As we conclude, do you agree with Peter Schiff's assessment that the Federal Reserve's rate cut will fuel inflation and destabilize the economy, or do you think it's necessary to prevent a recession? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.